Morning, the government is deploying emergency measures to stop a potential banking crisis.
Trading in several regional banks has been halted.
Stock markets in Europe and Asia have slumped.
The banking system is safe.
This is the worst single day on Wall Street since...
No, none of that was a dream. The entire market has been shaking by, well, our economic reality. Now, investors, I say it video to video, but more pain is on the way, and now is the time to actually prepare before it is just too late. If you're brand new here, my name is Ari, your value and dividend investor here on YouTube, delivering economic insights and updates as well as stock ideas and from time to time, words of wisdom from other masters of the market. As for today's video, I want to just get right to it with a brief account update, dive into some of the need to knows about our macros, and leave you with 7 dividend stocks that you could buy right now to set yourself up for, well, the remainder of 2023, which will be, as Fed Chair Powell says, bumpy. Before we dive in, if today's video delivers value to you, please tap on that thumbs up button, and if you're not already subscribed, tap on that subscribe button as well. It goes a long way and certainly helps me on my journey, given my mission is to simply be here for all of you and other investors. Now, with that being said, let's dive right in. Can I just say, what a mess we are in right off the bat. And as for my account, it has been ebbing and flowing with the market, ultimately up from my last video amidst all the volatility, currently sitting at $107,565.19. Now, as you all know, I use volatility to my advantage, so I'm not sitting here in fear by any means, and my portfolio is designed to perform well regardless of the economic environment. But while we're on the topic, let's talk about some macros. As you know, I always say macros matter, and I say that because understanding our macro environment helps us all narrow in on stocks, or generally speaking, certain sectors that we should be investing into. So before we talk about Silicon Valley Bank downfall and the shock of Credit Suisse news, it's important to note that the Federal Reserve was likely to raise interest rates by 50 basis points after their next FOMC meeting at the end of the month. Why? The employment report came in above the expected 225,000 jobs, meaning the Fed had the room to run to get inflation down, which at that point was at 6.4%. The key data set to determine their next move was our latest CPI report, which is now pinning inflation at 6%, which is a battle won, but the war is ongoing, and with the Fed having a goal of getting inflation to 2%, it's really not going to change their hawkish tone all that much. But the Silicon Valley Bank happened, and of course the market was in complete hysteria. Was this another 2008 situation? No. The reality is Silicon Valley Bank just did a horrendous job managing their balance sheet, and I sat here for days just trying to understand why in the world would a bank that already had arguably the riskiest of clients of all, tech startups, invest into long-term 10-year plus maturity bonds when Powell and the Fed gang had only said that they were going to raise interest rates. Just doesn't make sense to me, and it's a complete attempt to fight the Fed and bet against them. Now, any old Joe knows that they should never fight against the Fed. On top of that, Credit Suisse was just bailed out, but that too shouldn't be too surprising. So what now? What does it all really mean? In my opinion, it doesn't change a whole lot. I don't think that the Federal Reserve will ultimately change course because of some banks which were already bailed out, by the way, that couldn't even literally manage their balance sheets. I think the Fed will raise rates by at least 25 basis points, and as I have been saying, more pain is going to be coming our way, and we need to see sector by sector layoffs. A recession at some point is just inevitable. Now, as for us, it's about playing it smart and investing wisely. This leads me to the 7 dividend stocks that I'm going to run through today, which all have the leadership teams, brand names, and clean balance sheets needed to see through the market uncertainty that we're currently experiencing. So first up, you better believe I am jumping into the banking sector, given the opportunity to invest while the market is fearful, and I'm going to do it with Bank of America, ticker symbol BAC. But this is not to say that JP Morgan and Wells or any of these other larger banks are bad investments. As for Bank of America, it's already a sizable position in my portfolio, and it's America's second largest bank by assets of over $3.1 trillion, with a market capitalization coming in around $230 billion. Yet, with all the fears within the banking sector, Bank of America is down over 31% from this time last year, trading for $28 a share, with a PE ratio coming in at just 9. Now, as mentioned, banking troubles are brewing for those banks with a riskier balance sheet, but with larger banks, well, I would say shareholders need not worry much. A matter of fact, smart money isn't, as they load up on shares worth of Bank of America to seize the discount opportunity, and analysts are on the same page, rating the bank a buy with a price target coming up to $39.87 per share. That's nearly 40% worth of upside, and in due time, as a thank you for your investment, you're going to receive an above average dividend, with that yield coming in at 3.04%. But if you want to avoid the banking sector entirely, I hear you. So let's dive into Caterpillar, ticker symbol CAT, which is the world's largest manufacturer of construction vehicles and machinery, ranked 65 out of the Fortune 500 companies that has weathered many economic downturns and managed to grow year over year since their founding in 1925, amassing a market capitalization of $116.52 billion. With the economic environment in mind, less construction is happening, meaning a decline in sales, resulting in their share price sliding in recent months by 6.2%, trading for $217 per share, to a peak of over $260 per share. As for their PE ratio, it's below 20 at 17.8, but Caterpillar is likely to be on the comeback when the market does, which is why analysts see upside of over 18%, with the share price rising up to $257.07 per share. On top of that, insiders like their CFO with similar sentiment, as he invests over $2.9 million back into Caterpillar, while smart money also begins to take full advantage of Caterpillar's decline. Now, with patience, we'll all reap the above sector average dividend yield of Caterpillar's, which is sitting at 2.17%. However, if you want to play it even more defensively, General Dynamics, ticker symbol GD, has you covered as the 5th largest defense contractor in the world and in the United States. General Dynamics specializes in aerospace and military arms, meaning their clients range from the United States Army with a recent $993 million ordnance deal to the Australian government recently contracting a nuclear-powered submarine costing a pretty penny, all allowing for their market capitalization to climb over $50 billion. But as defensive contractor investments can be, they aren't immune to market volatility, and here we see their share price has slid by over 12% year to date, trading for $216 per share. As for their PE ratio, sits at just 18, and that has certainly attracted big-time investors like Ray Dalio, among others, to begin investing into General Dynamics, while analysts are also optimistic about upside as they foresee over 22% worth of it, with the share price climbing to $266 per share. As for shareholders, there's a cool above sector average dividend yield to take advantage of at 2.35%. Next investment, it's actually the next core position I'm scaling within my personal portfolio. It's Procter & Gamble, ticker symbol PG, which, if you're not familiar with the name, I'm positive you know their brands, as they really have quite a monopoly on diapers, detergents, home cleaning, and personal care products. And given I use those products every single day, buying them without a second thought, regardless of the state of the market, this is an insanely reliable investment. Now, since their founding in 1837, that market cap of theirs has only grown, coming in over $329 billion. But as investors move forward with hope for better days and try their odds at riskier investments, Procter & Gamble has slid by just over 5%, which I would predict will likely rise again pretty quickly. But as for now, it's trading for $141 per share with a PE ratio at 24.6. Given the nature of P&G, call that a safety premium. Whereas smart money overlooks that premium, padding up their portfolios for the remainder of 2023. As for analysts, the upside potential is there, with the stock share price rising to $160.17 per share, but it's the dividend that hooked me, coming in above the sector average at 2.57% worth of a dividend yield. Next up, let's dive into Texas Instruments, ticker symbol TXN. It's much bigger than their smart calculator operation, as Texas Instruments designs and manufactures semiconductors and various integrated circuits. Now, I'll keep this one short. Supply and demand. Demand is falling as businesses and consumers struggle. So here we are with Texas Instruments, up on the year, but back off its peak of $184 per share, trading for $174 per share. That PE ratio at 18.7. Now, here's where I share that Texas Instruments may not slide more, but it very well may amidst the recent volatility. However, think longer term. That is to say that smart money is doing so, and we can see plenty of hedge funds loading up on Texas Instruments, whereas analysts foresee even more upside, coming back up to over $185 per share. And until we see the market recover, whereas semiconductors are going to be back in high demand, we can reap the benefit of a dividend over the sector average yield, coming in at 2.74%. Moving right along, let's talk fast food, but stray away from the overpriced McDonald's to invest into the King and Restaurant Brands International, ticker symbol QSR. It's not just an investment into Burger King, but Tim Hortons, Popeyes, and Firehouse Subs, which I'm sure you are familiar with one or two or all of them. Nonetheless, all in, Restaurant Brands International has amassed a market capitalization over $18.7 billion, billion. In my opinion, as it slides, it's becoming more of a value offer than what good old Ronald is offering, as it's down by nearly 5%, trading for just $61 per share, with a PE ratio coming in at 18.6. But my green go flag is up because regardless of the economic conditions, people will continue to eat and likely enjoy their fast food, which is also why I think plenty of hedge funds have begun to buy in on Restaurant Brands International as well. And moreover, analysts forecast upside of over 20%, with the share price coming up to $73 per share. But until then, you'll digest a nice 3.38% dividend yield. Finally, a shout out to my father, who used to head regional sales for Kodak and has shared insights with me previously on the power of Eastman Chemical, ticker symbol EMN. Now, it may not be the sexiest nor as exciting as some of these other investments out there, but this chemical industry leader plays a global role in providing specialty chemicals to companies in order to produce materials and fibers across market verticals, making Eastman an insanely lucrative investment with a current market capitalization of over $9.8 billion. Again, think overall supply and demand, and we see a share price beaten down by over 22% from this time last year, trading for just $80 per share right now, with their PE ratio down to 13.2. Now check this out. Investors from George Soros with a brand new position to the all-famous Cathie Wood swooping in to add more shares worth of Eastman Chemical, and on top of that, analysts with upside forecasted coming up to a share price of $96.62 per share, which makes for over 20% worth of upside, which is not too shabby. And if we're longer term on this position, as one should be, a shareholder will reap an above sector average dividend yield coming in at 3.86%. And there you have it, investors. From Bank of America to Caterpillar, General Dynamics to Procter & Gamble, Texas Instruments, Restaurant Brands, and Eastman Chemical, the 7 dividend stocks to invest into now, should they be suitable for your portfolio and after your due diligence is conducted. But I would love to know your thoughts on any or all of these dividend stocks, or if you have better ideas in mind, so feel free to drop a comment down below with those thoughts. And again, if today's video brought any value to you, it would certainly mean a lot to me if you tapped on that thumbs up button to let me know. And if you're looking for weekly stock ideas, then subscribe while you're at it. Until the next video, I will see you all there.